Good morning. This is Dividend Coffee, and this is just going to be an update on how I'm doing in the stock market and where I currently am to date. So it's this is what I would call, for me anyway, the big stocks and shares sell off. So my personal view, and this could be absolutely completely wrong, but my personal view is that though everything seems to be doing quite well in the US at the moment, I think longer term, over the next couple of months, I think things will eventually go downhill. I think to recover from the tariff war will take some time, and I think there will be a little bit of a downturn in the market. And how much that downturn will be, I don't know, but I just think there's going to be a bit of a downturn. Also, the other side of the coin, I'm trying to change my investing strategy. And so I haven't been investing for too long. And I've tried certain things out, like investing with 10, 15 shares at a time. And I've even looked, when I first started off, at a good strategy for dividend investing. But the realization has come for me that what I actually enjoy with stocks and shares in the stock market, what I personally enjoy doing is buying and selling shares and trying to make a profit on the difference between the buy-in price and the sell-out price. And we're all very different. And if somebody is a long-term holder of shares, that's absolutely fine. That's just one strategy. And if that's what somebody wishes to do, that's absolutely probably a great strategy. But that would actually bore me to tears now. I'm an old age pensioner, and 60 plus. And to be completely honest, I think that would bore me to tears. And so I'm really going to change my strategy, and that is I'm going to buy into one or two, maybe two or three companies with increasingly larger buy-ins, and then try and sell at a profit to make a bigger increase in profit. Is this strategy more dangerous than my previous strategies? The simple answer is yes. If I'm buying in and say using 1/3 of my portfolio, which is 2,660, or even more than that, into a single stock, if that stock goes down for a long period of time, then I'm basically won't be gaining any interest on that on it. If there's a dividend, maybe eventually get some dividends from it, but that would be a little bit of a failure. So the other aspect of this is to concentrate more on stocks that are very volatile, so they fluctuate quite a lot. and hopefully that will reduce the chance that I've been locked out on that stock. I have had this problem before, and I have been locked out on stock for up to 3 months, and in other words, not made anything apart from dividends off that stock for 3 months. It could even go up to 6 months on the stock that I've currently hold. And but what I've been doing as well is selling out of some of my positions, taking that money and reinvesting that money into positions that are quite low down. So it means my average buy-in price is reduced down, and therefore when the price comes up on that stock, it goes over the average. Therefore I can make a profit on it, sell out of it, and do exactly the same to other shares that I hold. And in a bear market, that's probably a very good strategy to sort of get out of that bear market if you've had that bear market going on for a long time and you don't want to just lose or sell out of the market and at a loss. So that's probably the worst thing you can probably do. Maybe sell out at a little tiny loss if it means that by reinvesting that money somewhere else, there's an opportunity to make more than the loss that you sold out of. And I've done that on, I think, 1 or 2 occasions. And I put it into somewhere where I was pretty sure that it was going to make a profit, and they did make a profit, and I made more than I actually lost. So that's how I'm now starting to think. So my strategy is now changing. I'm trying things out. I'm seeing what works for me and what doesn't work for me, and seeing what's good and bad. And I've only been doing this for less than a year, so I'm still in that sort of phase of trying to figure out what works for me. And the one thing I've started to realize straight away is that you can have several different things and they all work differently for different people and work well for different people. So you can have somebody who's a long-term investor, who's young, investing in the market long-term, never looks at it, has put into good companies, never looks at the share price, and will have a look every year or so and see it gradually go up over the years. I prefer to be buying the dip. I'm in my 60s. Hopefully that will make me more money, and I haven't got the years to go, to be honest, to do what I call a younger person strategy. So on the other side of the coin, I have invested 2,660 so far. Well, I've invested less than that. That's what I've got in altogether, considering I'll show you a little bit later on what I've made in profits. But to be completely and absolutely honest, the money that I'm investing here is not what I call safe money. This is money that I can enjoy and have a bit of fun with. And if I were to lose a bit of it, it would not really matter at all. I do have other investments that are incredibly safe and don't rely on the stock market going up or down. And that's where most of my money is, in completely different things from the stock market. So to me, I can try things out. I can be a bit, do some, what you'd call probably quite, I wouldn't call it the word dangerous, but quite risky. I think risky is the word to be used. More risk than maybe somebody else investing in a different style. and I'm moving actually from a less risk approach to a more risk approach, where I'm putting it in hopefully just into 2 or 3 shares, and I'll see how that goes, see how it works out. So let's just take a look at let's first of all go and have a look at what I've actually. So let's have a look at what I've actually sold out of then. And I sold out of BP. I made £6.26 on BP. I sold it again at BP and made £1.82. So that was roughly about £8 I made. And I sold out at Duke Capital and made £5.74. All of these are really good. I found very good investments, and if they go really down a lot now, I might buy back into them. But Duke Capital, I do like, sold out of that because I think I want to use the money towards reducing my average on other stock. And I made a profit at the same time, so it was a win-win. And I still got Rio, but I've been buying and selling Rio. Sold out of Raspberry Pi. I know 3-4 pence, and I sold out of that because again I wanted to put the money towards something else to make more of a profit on, and so that's why I sold out of Raspberry Pi. And so if we go back to what I've actually got left, here I am. I've got Greg's, which has been a thorn in my side, to be completely honest. It's I've got 400 invested in it at the moment, and Greg's has just had a huge crash over the last, if you just take the last 3 months, see this huge from 2100 rolled down to 1822 at the moment, and it went down lower than that. My average buy-in, I've reduced it down. It was higher than that, but it's now down to 1909.1. And hopefully, if this, my view is if Greg's go down further, I will buy in a bit more and it'll reduce the average down. And hopefully, eventually, it'll go above and I'll sell out of it. So I'll get out of Greg's eventually. And Greg's is one of those stocks that seems to have these big, huge drop-offs very quickly, and it does so much for so far, and then it'll have a big drop-off, which is a little bit of a pain because when it fluctuates up and down, you can make some good money out of it. When it has these massive big drop-offs, then especially if you're actually in a trade at the time, it can be really a long time to recover. So I think Greg's will be better if it's actually going up in price, not down in price. And so if it's a bullish market, not a bear market. And so Greg's, I think that it'll do better when it's on its way up. So maybe time to buy in when it's actually going up, not when it's going down. And that's my thoughts. I'd like to get out of Greg's. I got at the moment I'm £19.18 in the red with Greg's, and which is a little bit of a pain because that's reduced down my my actual profits so far that I've made since starting. And Then we've got Vanguard S&P. Again, another thing I really probably shouldn't have invested in when I had. It's gone down. It's now coming back up. Hopefully it'll get above my 824130, and then I might start taking a little bit out of here and selling off a little bit to reduce the price down, just in case the American market starts to crumble. I think it will in the next couple of months. It's just my own view. I could be completely wrong, but I think it will start to crumble. And when it does, I think I don't want to have an awful lot in the S&P. But when it bottoms out, maybe a good time to buy in at that point. But at the moment, yeah, I'd like to. I'm £10.64 down at the moment, and I'd like to get out of Greg's. I'd like to get out of the Vanguard S&P or partly out of it as soon as possible. And Greencoat UK Wind. These seems to be between 110 and 119. They go an ex-dividend on the 15th of April. So before long, they're going to be ex-div. And therefore, you'll make, I think, I don't know how much it is, but per share, though, 3p a share. So whatever you've got, so I'll make roughly about £3. So look. Yeah, just over £3, £4 area, if it's 3p a share. So yeah, that's a little bit of a pain, but I haven't been happy with Greencoat Wind. I think this probably is a better long-term investment, especially if you like dividends 4 times a year. But I think I'll probably get out of here ASAP. I'm not fussed on them. I'm going off them, and I think that I'd be better off putting my money somewhere else. And so I'm really down to 4 shares at the moment. The only one that I really am happy with at the moment is Rio Tinto, and they're currently quite low at the moment. They're 4,496.5 pence a share, which means that if you take the comma in the middle, move it over 1, it's £44.96. Is basically what it is per share. That's how it works. You just take the comma over 1 place to the right, and then you know how much that share is actually worth in pounds, especially if you've got British pennies. So it's kind of hasn't been doing a lot all through the week. It's been kind of moving sideways. I'm hoping this will start to move upwards, to be honest. And next week, hopefully, I'll make a profit on this. I've got £1,094.45 invested so far. For 1 share, that's like over 1/3 of my overall portfolio. So that's why I'm saying now that I'm moving into a very high risk strategy with the stock market, and hopefully the increase in actually what I make per share should be should improve. So we'll see how it goes. It's just a different strategy, probably a bit more dangerous strategy, but it's a strategy which I think I'll be doing a lot less buying of shares. and I'll be doing a lot more waiting and for what I consider a price point, which I think is basically will have to go back up, because that price point will be at a point where statistically it's very low for that particular share. And again, I haven't just bought into them, just gone and bought 1,094 pence worth of shares. I've slowly bought into this over time. And what I'll do, I'll sell out of it over time as well. So I might sell £500 worth if it starts to go up and keep a little bit in reserve. So if it continues to go up, I'll still make even more money. If it goes back down, it means I can then take the 500 that I've sold, and then when it goes down far enough, I'll put it back in, and hopefully we'll roll that again and it will go back up. So there's the strategy I have in place for Rio, and we'll see how good this strategy actually plays out, and over time. So this should be an interesting strategy. So I have been selling off my shares for two things. I think the stock market in America is going to go down in about 2 to 3 months. It's just a guess. It's my view. It could be completely wrong. And if that's the case, I think that it'll impact on the UK stock market, because it has recently, when Trump set all the tariffs, the stock market in the UK went down, as well as the stock market in America. So we're now really, we're talking global stock markets really. If one goes down, all the others tend to follow. So yeah, we're living in that sort of world. And yeah, that's all I really thought I'd discuss today. And so the two reasons why I've done I've changed my strategy. The first one is I want to try out something new, and the second one is that I think America may actually end up having a big downturn in the next couple of months. Of course, that could completely change if Donald Trump, who's an incredibly good businessman, changes and maneuvers on the tariffs. And if he does really well on that and makes a lot of money for America, I think, yeah, the stock market might turn around a little bit. But he's going to have to reduce the tariffs, because at the end of the day, it just seems to me, and I could be completely wrong, but it just seems to me that the American consumer will end up paying for all these tariffs. So he's going to have to do something. So we'll just see how the markets react to what he does. And but my personal feeling is that I think we're going to have in a couple of months' time, I think we're going to have a real bad bear market. Maybe even worse than we currently got at the moment. And but the upside of that, it could actually turn around and go completely in the opposite direction if the tariffs and the world economy and bonds settle down. And so we'll have to see how it goes, and what happens to inflation as well. So something to watch. And I think just to have a look at my realized profit, I'm now up to £212.33, and I've made this profit through this is the profit I've made over the first year, and I think that's pretty good for a beginner. And so I've invested some of this back into the stock market as well. So that profit is probably fluctuating, but I've made £212.22 profit within less than a year. So I don't think I'd do that much better if I had the same amount of money invested in a bank account. So also I've made £30.51 worth of dividends, which I bought and sold Taylor Wimpey as well. So that's one of the ones I've sold out of. Again, if the price comes down on Taylor Wimpey, I certainly buy back in. And Taylor Wimpey, I think it's even now it's at a fairly good price to buy in at. Saying that, though, it could go back down a little bit further, and but it has been a lot higher if you look at the graph for Taylor Wimpey. So it's something that maybe somebody could put in a little bit to start off with and then see how it goes. But it's something which is quite interesting. I certainly wouldn't advise anybody to invest in any stocks at all, whether Taylor Wimpey or anything else. It's just something that I would do, and at the moment I haven't got anything in Taylor Wimpey. I bought in when it was a lot lower, and I've already sold out of it and made quite a nice profit on it. So I was happy with the profit gain that I made on there, and it also made me £9.70 worth of dividends whilst I had them. So very pleased indeed, and interest on my stocks and shares ISA account is £6.56 so far, which is not an awful lot, but it's using, wait a sec, it's using qualifying money market funds, and so that's what I got in qualifying money market funds so far, and that's what I get interest from. And so it's split up between quite a few qualifying money market funds. I think that's probably some extra protection you'd have. And so at the moment I've got £439.63p in cash that I can buy more shares with. The interest rate for the qualifying money market funds is 4.60, pretty better than a lot of bank interest rates, to be honest. So when I'm not actually buying stocks and shares, I just leave my money in here, and it still makes more interest than most bank accounts. So that's really all I have for today. So at the moment I've got £2,221.18 invested. My overall portfolio is £2,660.81, which means that over the year so far my rate of return is 14.2%. And this moves around quite a bit. It looks impressive considering if you had a rate return of a bank for about 4%, you'd be very happy. So my rate of return at the moment is 14.2%, and so far if I sold everything now, even if I sold everything that's year at a loss, I'd still make £126.34 in profit. The profit from the realized profit is if all of these were positive. So if Greg's, Vanguard and Greencoat were all positive, and that would be my maximum amount of profit that I could possibly make for the year to date, and that would have been higher than the £126 which count. But this fluctuates around because obviously I got money in the stock market at the moment. Over the last 24 hours, I've made 0.06% or 0.1, and yeah, so that's where we're at. And anybody watching this video, thank you very much. And the only other thing I would say, that if you have a stocks and shares ISA account, then, and you have an ordinary cash ISA account, I think you're going to have to check this yourself, because I might be completely wrong. But I think it's the accumulation of both accounts that the government allow you to have up to £20,000 tax-free. So it's not 20,000 for each one of the accounts, as far as I know. So maybe something to check if you're unsure about it. But I think it's 20,000 for both accounts. So you have to check how much is in each account and make sure it's less than 20,000. And if so, then everything is completely tax-free. Obviously for that particular year. And yeah, anyway, this is Dividend Coffee. I'm going to go now and have a cup of coffee, I think. And this should go out sometime today. Thank you all very much. The only other thing I can say as well about the subscription thing, if you'd like to subscribe, and please do so. Usually if people do a search, they don't tend to find me, because I'm very, very small. I don't tend to come up for about the 100th down or something on a search for any stock or something. If you were lucky enough to find me, then I would suggest that, and you'd like to sort of follow me on, I am an old age pensioner. If you'd like to follow what I'm doing in the stock market, just out of interest, and yeah, feel free to do that. And but I would suggest that you subscribe to me, because that's probably the only way you're going to find me again. If you put me into, unless you remember Dividend Coffee and you put that into YouTube search. Otherwise, probably the best other approach would be just to subscribe, and then it'll tell you every time I have a new video out. Okay, thank you for now, and this is all I have for today, and bye for now.